rates, a beginner's guide to them. Interest rates are hot right now, my friend. And every time interest rates or currencies or some of these other markets go from being, second and third tier in people's minds to being the headliner, a lot of people come knocking on my door and are like, hey, how does this stuff work, man? Like, you bring up interest rates and you talk about the 2-year and the 10-year and the yield curve and these different things. What's the difference between yields and bonds? And when one moves, how does it affect the other? And how do I, what's the easiest way for me to learn about this thing and get into this suite of products that, like I say, is hotter than any right now? And since we get all those questions at a time like this, I thought, why don't we jump on with Jermal, who's been trading for a long time. I've been trading for a long time myself here, and just chat it up, man, and figure out all the answers to these questions for viewers out there. Before we get into the actual content, and we'll try to answer all of those questions that people have on interest rates, is there anything in your mind that's like a roadblock for people usually with interest rates? Or do you want to give people maybe a quick background on how you view the interest rate market as a whole, like the broadest way that you could view it, interest rates here as an asset class go?
Well, I'll talk about the broad part, and then I'll talk about the roadblock part. So the broad part view in my mind is really, when I think of rates, I probably think more of, there's so many durations, right? But I guess just to keep it simple, as far as these days, what I think about, even though we're going to talk about 2-year, I think more about 10-year probably every day. And I think about 30-year. I think about, so that's considered the note, right? 10-year note and the 30-year bond. And I think about the levels that they're at, right? But just as a simple, literally based on where they are currently, let's say. However, I think the roadblock for people, and even myself, because again, I've really just started trading yields. While I've been aware of them a lot of times throughout my trading career, depending on what's going on in the general market, I think the interesting roadblock is, so let's just take Apple, and I know where Apple is trading now. And let's say Apple's trading 147, forget the splits, right? And so say 5 years ago, if Apple was trading $50, well, I know it was cheaper then because it was a smaller company because they were making less widgets, right? And so on and so forth if it's trading higher. And I think the roadblock for yields is, I don't necessarily know specifically if a yield is trading at a certain place, why it's trading there. So we're just talking about 2 years, what we're going to talk about today. Why is it trading at the level that it's trading at? And what does that mean compared to, 2 years ago? However, a year ago, of course, we had a pandemic. And I guess really the best thing about this is the fact that we've had so much movement. Usually that's when you get to learn something about a product, when it 100%. Moves a lot, right? And so that's, I think, the great thing that we have going on for us right now.
Awesome. We're going to answer all that. So, and I'm glad that you called that out, because I think that is with any asset class. We just, talked about the new small exchange crypto futures there. It's a similar thing where it's like, I'm not trading it because I don't understand what makes it go. And it's like, I understand that you think you know more about iPhones and these other different things, and thus what makes Apple stock go. But I would contend that plenty about what makes interest rates go. So let's actually lift the curtain a little bit, demystify some of those points that do move interest rates. But first, I want to just bring up why everybody is talking about interest rates in the last week or so. And that's because short-term interest rates, and we're looking here at the 2-year duration, they're up 300% this year, which is to say that the 2-year yield, or the 2-year interest rate, has gone from about 10 basis points, which is 0.1%, to above 40 basis points, which is 0.4%. And thus the futures that you're looking at here are the S2Y futures, which are the small 2-year futures. They've gone from a price of $1, which is 10 basis points, to above $4, which is 40 basis points, which just, if you bought that thing and then sold it today, that would be an appreciation of that product's price of 300%. And it's just movement like this, like Jermal says, movement is what helps teach you, but movement is what attracts people to interest rates. Because if interest rates were just flatline, no one would care. Everybody would be talking about S&Ps, NASDAQ, and cryptocurrencies. And this came across your desk, right? This big move in short-term yields, the 2-year duration.
Yeah, I've been noticing it more recently too. And I think we should clarify, just for those who may or may not understand, the idea of 40 basis points. That's when they see it in a different term, in a different way, 0.4%, right?
That's exactly right. A basis point for everybody out there is 0.01%. And thus, 100 basis points is one full percentage point in yield terms. Now, let's that's the headline. That's why a lot of people are talking. And we'll get to here in a second what the difference is between 2 years. And like Jamal said, and I agree with him, the more popular benchmark, the 10-year and then the 30-year. Those are kind of the three main points in the yield curve, so to speak. But first, I want to illuminate a little bit of this idea of what this 2-year is, what interest rates are, and what has driven this move. And so the 2-year yield is the shortest term benchmark for interest rates. And keep in mind that right there, if you boil this sentence down, Jamal, if you take all of the other stuff out of it, yields are interest rates. So keep that stuff in mind, because that trips people up. It's like, oh, well, like, what happens if interest rates rise? What happens to yields? It's the same thing. There is no cause and effect, which I think is a big thing for people, especially when you rope in, like we're about to here in a second, the bond price or the note price. It's like, well, which moves which? And it's like, they're the same thing. They move in tandem. One doesn't cause the other one to do anything. But all of that aside, you look at this, Jamal, this is a really intriguing market here. One, you can tell that it's a market that has pretty distinct boundaries in terms of, like, it doesn't drift higher or drift lower in one direction. It's been as high as 5 or 6%. It's been as low as 0%, and it trades back and forth in the middle of that range. Now, you spoke to, a lack of understanding among traders who kind of stay away from interest rates in terms of, like, what moves this market? Why are 2-year yields up so much? Why are these interest rates, these short-term interest rates that you're talking about, up so much? And a lot of this move and movement in general in short-term rates, Jamal, is caused by the Fed, because the Fed controls the shortest term rate, which is the Fed funds rate, which we don't trade because they literally say, hey, it's here, or hey, it's here. And thus, there's not a lot of trading back and forth. But recently, the Fed has started to say, hey, the pandemic happened and we brought short-term rates down to zero. And that's this little blip that you're seeing here from 2020 until recently. And now, since we're feeling like the economy's back on the upswing, and you see stocks are at all-time highs, and we feel there's a less of a perceived risk in the market, we're thinking about bringing those short-term rates up. And thus, the 2-year yields have moved higher. Does that make sense? The influence that the Fed garners over 2-year yields and short-term rates in general?
It does, yeah. Especially when you have this longer-term graph, because I can, and that's the luxury of me having traded. I can see the times where the Fed definitely intervened in the markets and created a situation where they brought those short-term rates down really low during the financial crisis in 2008, and then also again in 2020. I guess you could also, again, I wasn't trading in 2000, although I was around. I just was in grad school at the time. But I do know that the markets, there was a lot going on at those time periods. And I would imagine, knowing what I know now, that's why we see the big drop in the early 2000s as well.
That's exactly right. And this is what I really am pushing people to understand is, like, a lot of people think that yields and rates and bonds are like this alien thing. And it's like, once you kind of, you can grasp a couple of these things, all the stuff makes sense. It's like, oh, it was high in early 2000, the short-term rates were, and then they went down all the way down to zero. What was happening in that time period? And it was like, well, stocks were crashing and there was a lot of fear in the market. And thus the Fed brought short-term rates lower to try to, make borrowing easier, to try to kind of ignite the economy amid some poor times. And then guess what? Stocks rebounded and they traded pretty well, got back to their highs in the mid-aughts going into 2007 and 2008. What happened in 2007 and 2008? Well, the stock market crashed again, and we saw the Fed bring down interest rates, and thus Treasury yields and interest rates in general came lower. And then what's particularly intriguing is I start trading in about 2015, 2016, and rates are at zero, and stocks are starting to get back to all-time highs and feeling really good. And you see this uptrend, this grind higher from, call it 2015 until 2018, 2019. And that's the Fed hiking their Fed funds rate, and thus the 2-year yields moving from 0% to 1% to 2% to 3%. And then, my friend, what happens in 2020? Pandemic breaks out, stocks go crashing, and the Fed brings yields lower. And so that's just a nice little story of like, these things there's a synergy to them. Like stocks and bonds are, really part of the same organism. And I want to keep that word on our minds here, because within the interest rate asset class, yields and notes and bonds are all part of the same organism. And what you have here, Jermal, is the old traditional product, the ZT, which is the 2-year note price. And you have S2Y, which is the 2-year yield. And now you can see here that like a lot of people will always be like, oh, so if bonds or notes, which are just different durations, the same concept, if bond or note prices move higher or lower, what does that cause the yield to do? And it's like, it doesn't cause it to do anything. They move directly as a function of each other. It's always, and you come from options, maybe you can speak to this a little bit. It's like when stocks move lower and put prices rise, and implied volatility rises from 15% to 20% to 30%. And it's like, oh, implied volatility is rising because of X, Y, and Z. And it's like, no, implied volatility is a function of put prices. And since those prices are rising, IV is. And it's the same thing here. When note prices or bond prices are falling, the yields are rising. It's the same organism. It's not a cause and effect thing, right?
Yeah, no, I mean, I think you could even simplify it even further and just put it in terms of two securities, the VIX and SPX or SPY, whatever, right? Put those two on a chart. Similar type deal. They're inversely correlated. So I mean, while these, I guess you could say these are inversely correlated, but they are just two sides of the same coin, basically. So yeah,
exactly right. Yeah.
Yeah.
Exactly
no, I mean,
right.
Hey man, I sat on the options trading desk for the first like year and a half, 2 years, and I didn't always understand exactly what was going on in this realm. Admittedly, there was a lot going on in those first 2 years from 06 to 08, but
sure.
It wasn't until 08 where I really started to understand at least the idea of why notes and where you see the difference between the yield and the actual price. And we didn't always, at that time, I couldn't always see the price of the bond. So I didn't really know what it was trading. So there was a lack of information there too. Whereas now I feel like you're able to see these a lot more clearly.
And you raise a great point, which is like, you can be around something like, you're a professional options trader and you're looking at VIX and SPX and all these things and trading and hedging and looking at this whole organism, like we say here with yields and notes and bonds, and not understand it for a while. Like I sat there trading interest rates at the Board of Trade for a year overnight, and I looked at this stuff every single day for more than 12 hours, and I didn't grasp it, I feel like, until actually I came over to Tasty Trade.
You know why? There he goes. You know why? I was going to say this. It's an unpopular opinion, but I'm gonna say it, and I'm gonna hype ourselves up as well too. Not every trader is as good at explaining these things. We sat around some very knowledgeable traders who didn't always explain these things to us. Honestly, like I'm not trying to like put anybody down. But I'm just saying there are certain people who can explain things better than others. And I'd sit next to a desk on traders. Oh my God, bonds are going crazy. And I'm like, wait, what does that mean exactly?
What is it? What am I supposed to do?
What does that mean? And what do you do because of it?
Absolutely right. And this is all to say that hopefully, we explain it a little bit better, but also there's nothing wrong with like, I understand just a little bit more of this stuff today. I don't fully understand it yet because it takes a while. Like I say, you sit here staring at this stuff for, days and weeks at a time, and it's going to take a while to understand, but hopefully we're getting you closer. And what I think is a good starting off point for people to get a little bit closer to understanding is form an opinion of what we've walked through today. We'll talk about 10 years and we'll talk about 30 years and these other parts of the curve in the future, but stick to this 2-year yield that we talked about today and how the Fed has influence, and it's rising right now because the Fed is projected to hike more in the next couple of years here, and place a trade in this most straightforward place, which is the small 2-year yield product. It costs you $70 to trade it. It's a $400 product, as small as it gets in terms of futures. If you think that this trend is going to continue and that the Fed is likely to hike a few times in the next couple of years, and that we're going to get back to this place, going back to this chart, we're going to get back to this place of 1 or 2 or 3% in the next little while, then buy the futures and just see how it feels. It's only going to move, $10, $20, $30 in a given day. If you think that, we're going to stay closer to zero, these projected rate hikes are a little bit too much, then sell the S2Y futures and just watch the thing move with sentiment around interest rates in general. You'll be reading the news stories about the Fed and you'll see your product moving as a function of it. And I bring up here the platform just to show you how easy it is to do so. You've got a market that's 26 by 24, 412 by 414, and actually a nice dip here on Tuesday afternoon to let you, if you were looking to buy. And what's really nice, Jermal, like I say, is a $73 buying power. You can't find that in futures. This is a $400 product. You can't find that in futures. Jamal's laughing because there's no other product like this, right?
No, not at all. And to try and, I think bring a little more clarity, just not just for the people, but for myself too. The idea of this 2-year, like you said, the Fed has some influence over it. Is that essentially kind of, getting to this point that, let's say right now it's trading, S2Y is trading 4. Is this kind of, and for the most part, when Fed hikes rates more recently, like let's just say in 25 basis point intervals, right? So is this kind of saying that right now in 2 years, most traders are anticipating a greater than 25 basis point hike and maybe close to a 50 basis point hike?
I love where your mind's going. It's a rough estimate, but yeah, you're right. Right here at $4 or 40 basis points is kind of projecting in the next about 2 years, the Fed will hike a little more than one time or a little bit more than 25 basis points. It's not quite at 50, which would be 2 hikes there. And thus the upside is if you think the Fed is going to hike more than one time, more than 1 or 2 times in the next 2 years, the downside is the reason to get short would be like, I don't think they're going to hike at all. And I think that maybe some further chaos in the equity market is coming and they're going to have to stick at 0. And thus this market will come right back down close to 0. And so here I just show you to end the segment how easy it is. The buying power is low. The fees are extremely low. And like I say, the market moves about $10, $20, $30 on a given day. I'm just going to lift the offer here, give up my $1 and see right there. I bought it for $14. And guess what, friends? All I want the thing to do is now go higher. If there's more sentiment in the next 24 hours or the next week of trading that the Fed is going to hike a little bit more often than we had formerly thought, then this market will move up to $4.50 or even $5 or what have you. If I'm wrong, it'll move down a little bit. But you can see the last week of trading here is about a $50 range or 50-cent range. And so it's a really nice way to get a little bit more comfortable in interest rates. And there's your beginner's guide to interest rates, friends. I think we did a good job. What do you think, Jamal?
I think so too, my friend. I think we laid a lot of the basics down, and I think I just might have froze a little bit, but sometimes that happens, unfortunately.
No, you're good. You're freezing up a little bit now, but it's a great time for us to. No, you're great. We're going to close the show anyways here.
I think we did a great job.
Awesome job. Awesome job as always, Jamal. Thanks so much for jumping on with us, giving the people what they've been asking for, a beginner's guide to interest rates. You got other questions, hit me up on email and Twitter and everywhere else, Frank_Caberna on Twitter there. And we can answer even more questions on interest rates. They're not going anywhere. Well, they are going places, and that's why they will be in conversations for the coming weeks and months. So hopefully you got a little bit more comfortable in your trading rates. Jamal, thanks as always. Everybody, thanks for watching. We got Splash into Futures coming up next. Stick around for that. Another funky day in the market. I'm sure Pete Momet has some trades in the Tastyworks platform. It's going to be fun. Thanks for watching, everybody. Peace.